Hi everyone, good morning. So today we're going to, we as a group, me, Thanesh and Ramakrishna Ramachandran, going to explain about the growth of new types of finance. So as an introduction, finance is money. So what is source of finance? So source of finance where we get money from. So finance is different source of finance will have different implication for a business. So it's important that the most appropriate method of finance chosen for the purpose that the business has in mind. So we're going to explain about eight types of new types of finance. We start with crowdfunding, peer-to-peer financing, microfinancing, mezzanine financing, venture capital funding, business incubators, royalty financing, angel investors. So the first four will be explained by me, and the last four will be explained by Mr. Ramakrishnan. So we're moving forward. First, crowdfunding. So, what is crowdfunding? Crowdfunding is accumulating funds for business or ideas to multiple avenues that involves networking in any possible way. So, basically, it is the process by which a group, basically a general public, collectively provides money for artists, researchers, businesses, and many more. So, uh, emergence of crowdfunding. So as you can see, there is the Statue of Liberty. So the Statue of Liberty has been born via crowdfunding. So the earliest reference of crowdfunding can be traced back to time during construction of the Statue of Liberty. It was partially funded by the people of America when the committee set up for arranging funds for the city failed. So what are the advantages of crowdfunding? So basically, it provides access to capital because crowdfunding is a great alternative way to find a venture, and it can be done without giving up equity or accumulating debt. And besides that, it hedges the risk. So, launching a crowdfunding campaign hedges the risk associated with startup ventures and serves as a valuable learning experience. And furthermore, it serves as a marketing tool. So, an active crowdfunding campaign is a good way to introduce ventures' overall mission and vision to the market. And other than that, it gives proof of concept because crowdfunding, a good way to gain some respect and credibility, is able to show to the market. Beside all these four, got another four advantages like it allows crowdsourcing of brainstorming, it introduces prospective loyal customers, it's easier than traditional applications, it provides the opportunity of free selling. So we moving forward. Uh, Issue related to crowdfunding. There are four issues related to crowdfunding. First, risk of fraud. Second, single of transaction. Third, theft of idea. Fourth, limited follow-up mechanism. So we start with risk of fraud. So what are the risks of fraud? Funds raised may not be used by the purpose as disclosed in on the platform. So the second issue related to crowdfunding is single transaction. Crowdfunding is mostly a single transaction rather than continuous like other forms of financing. Third, theft of idea. One's business idea may be picked by another and capitalized by them. So the fourth is limited follow-up mechanism. No mechanism to follow up the performance of the borrower. So that's the four issues related to crowdfunding. So we move forward. So the second new way of financing is peer-to-peer financing. So what is peer-to-peer financing? Basically, peer-to-peer financing, which is known as P2P, is a platform of debt financing that enables individuals to borrow and lend money. So it is without use of an official financial institution as an intermediary, but it involves more time, effort, and risk. Borrowers benefited by securing loans at lower interest rates compared to banks. Lenders also benefited from these sites as they get good return on which increases with the risk associated. So how peer-to-peer lending works? So basically it starts from borrower. So they will apply for a loan by giving some ideas. And the lending platform will collect the ideas and will pass to lender or investors. So from that, investors will be willing to invest on that project and then they will approach bank. So that's how P2P works. So the borrowers raise a requisition on the platform for the funding requirement. Platform then evaluates the credential of the borrower. Once the application is approved, the application is made open for the lenders. Once lenders' commitment is received, platform approaches bank to disburse the money. So what are the advantages of peer-to-peer financing? There are three main advantages of peer-to-peer financing based on our studies. First, higher returns to the investors. Because peer-to-peer lending generally provides higher returns to the investors relatively to other type of investments. And besides that, one of the advantages of peer-to-peer financing is more accessible source of funding. For some borrowers, peer-to-peer lending is more accessible source of funding than conventional loans from financial institutions. And besides that, one of the advantage of peer-to-peer financing is lower rate of interest. P2P loans usually comes with lower rate of interest because the greater competition between lenders and lower origination fees. So we move forward. So what are the disadvantage of peer-to-peer financing? So first, credit risk. Peer-to-peer loans are exposed to high credit risk. Many borrowers who apply peer-to-peer loans possess low credit ratings that do not allow them obtaining a conventional loan from a bank. Therefore, a lender should be aware of the default probability of his counterparty. Besides that, there is no insurance or government protections. The government does not provide insurance or any form of protection to the lenders in the case of borrower's default. And the last disadvantage of peer-to-peer finance that we're going to explain is legislation. So some jurisdictions do not allow peer-to-peer lending or require the companies that provide such service to comply with investment regulations. Therefore, peer-to-peer lending may not be available to some of the borrowers or lenders. So the next new way of financing we're going to talk about is microfinancing. So what is microfinance? Microfinance is finance that is provided to unemployed or low-income people or groups. It's basically a provision of small loans, microcredited to poor people to help them engage in productive activities or grow very small business. Microcredit is the extension of very small loans to those in poverty designed to spur entrepreneurship. So who are microfinance clients? So basically, as what I said just now, it it's mostly related to poor people. So it's for people who are not qualified for the banking system and no collaterals and no credit history. So how does microfinance work? It's system of microloans. Instead of using collateral to gain credit, loans are secured against the honor of peer group. If let's say one person fails to make their payment, others in lending cycle will be denied in the future. It is said that microfinance have lifted 100 million people out of poverty in last 3 decades. So what is the advantage of microfinance? So basically the advantage of microfinance, a broader offer, more choice of different managers and types of products, and low management fees, better and more professional risk management, the process to systematically exclude issues of ethical concerns from the portfolio. So basically there is four disadvantage of microfinance. First, foreign exchange risk assessment problem, default risk, volatility. So what is foreign exchange risk? Because 92% of the loans microfinance are denominated in hard currency. When we think about risk assessment problem, rating agencies like when they rating microfinance is good for transparency and uh, default risk. So no broad consensus about what the real default rates are. Estimated to be less than 1%. So we move forward to next type of financing, which is mezzanine financing. So what is mezzanine financing? Financing. It's a new type of financing, which is a hybrid of debt and equity financing that is used for the expansion of existing companies. Mezzanine debt capital generally refers to the layer of financing between a company's senior debt and equity, filling the gap between two. Structurally, it's subordinate in priority of payment to senior debt, but senior in rank to common stock or equity. Mezzanine debt may take the form of convertible debt, senior subordinated debt, or private mezzanine securities, also known as subordinated loan or junior loan. So, so we look at the advantage of mezzanine. So the advantages are no immediate loan repayment, long-term financing, no change of ownership, alignment of interest, and low transaction costs. While the disadvantage of mezzanine is cash flow burden, interest costs, intercredited challenges, and etc. So that's all from me. So other four new types of financing will be continued by Mr. Ramakrishnan. So thanks.
Hi, Prof. and fellow friends. I would like to continue with venture capital financing. So what does it mean by venture capital financing? It is a private or institutional investment made into early stage or startup companies. Exists only as an initiative for small business which has huge potential to grow. People who invest are called venture capitalists. And this is the process of venture capital. It starts with fundraising, and then they will be evaluating venture opportunities, and they'll be investing capital into enterprises and govern business to profitable growth, generate liquidity through IPO, and distribute returns to investors. There are several types of venture capital. Seed money, low-level financing to make the idea happen. Startup, financing for new companies to fund expenses like marketing and product development. First round financing is for manufacturing and early stages of sales funding. Second round financing is operational capital given for early stage companies which are selling products but not returning a profit. Third round financing, also known as mezzanine financing, which was covered by Thanesh in the earlier slides. And fourth round financing is also called bridge financing. It's proposed for financing the going public process. There are several good things about venture capital: business growth and sustainability. Huge fund flow into the company enables to expand it further. No debt or monthly payments, because lesser obligations to return the fund to the institution. Experienced professionals to help grow the business, because continuous guidance is the operation flow of the company. And of course, free media coverage and easy to reach customers. Few bad things about venture capitals are they can take a seat on company's board of directors, which results in tough decision making for the founder of the company. Might have to partner with someone they chose for the company due to one of the major ownership in the company. Funding comes with expectations, and founder might lose the joy of owning their own business. Next, we'll be looking into business incubator. So it does not directly cover financial aspects of a company, but indirectly it does. Business incubators are organizations that offer startups shared operation space. It can be physical or virtual. It gained popularity in 1980s when universities started to launch school-affiliated business incubators. It is to offer students better employment scope. So what do they offer and what are their goals? So different incubators provide different facilities. Majority offer marketing assistance, market research and analytics tools, access to accounting professionals, access to loan facilities or grant programs, and legal advice. It also provides businesses with basic skills from time to time, such as business etiquette, management, presentations, and pitches. Their main goal is to help startups successful because mostly they are non-profit organizations. Their support to the startups are based on funding from government, donations, and rental by tenants. Several types of business incubators in the market are virtual business incubator, which is for the online businesses, kitchen incubator, which is for the food and beverage industry, and public incubator is for the public goods services, And startup studio is interacting portfolio companies, and seed accelerators is for budding businesses, and corporate accelerator is for a larger company that acts akin to a seed in accelerator. There are good things about business incubator connection with potential business partners. It helps to train on presentations to get investors and help to link with known investors. In affordability wise, lower overhead and operational costs such as sharing secretarial office, production equipment and conference room. And rich expertise, able to leverage on the expertise from the business incubators such as efficient marketing plans and business expansion strategies. However, there are certain bad things about business incubators, such as lengthy application process. They demand a detailed business plan alongside with data of all business activities. Incubator involvement need to get adapted with the schedule set by the business incubator, including different types of trainings, workshops, and many more. Incubator is a stakeholder. Business owner is expected to be responsible for his mistakes, to answer all kinds of questions in regard to the company's progress. Next, we'll be looking into royalty financing. What is royalty financing? Investors lend money for a guaranteed percentage of revenues for whatever business is selling over a period of time. The money be put toward launching a new product or expanding the company. The investment can be considered as advance to the company, and periodic percentage payments can be considered royalties to the investors. And few pros of royalty investing are: founder holds the ownership because they do not need to give a chunk of equity to the investors. No repayment obligation because no worries during a down month for sales for the founder because payments are tied to a percentage of revenue only. No requirement for tangible assets, especially for the new businesses where steady profit and business model are sufficient enough. Balance sheet with no additional liabilities, because since it's a contingent liability and not a debt, it wouldn't be listed as liability in a financial statement. When we look at cons of royalty financing, it could be more expensive, especially if the revenue is higher or financing for longer period. Thus, the percentage of royalty can be higher than the bank loan. Royalty lower net margin, it would affect the company expansion due to lesser profit in the long run. Need to have a good revenue history to get the deal, because the royalty percentage is directly tied to the revenue of the business. Finally, we will be looking into angel investor. Angel investors are opposite of venture capitalists. Angel investors are also called informal investors, angel funders, private investors, seed investors, or business angels. They can be business owners' family, friends, or wealthy individuals whom invest in small startups and entrepreneurs. Is also a form of equity financing. There are 6 most important information for angel investors before they get into a startup or a business. First, experience or track record of founders. Second, a viability of business plan. Third, an innovative or disruptive product or service. Fourth, whether the business is scalable. Fifth, existing revenue. And finally, an exit strategy. Advantages of angel investors in the business are good for small to medium sized businesses because they might not have proper tangible asset to get bank loans, and funds required are smaller for venture capital. Easier to get them on board due to their acceptance for high risk ventures. Invaluable guidance because angels' knowledge and experience would help in growing the business unlike traditional financing. Fast funding. may require a short approval or waiting period for fund to be released. However, there are few disadvantages as well. Those are limited available amount for funding. Due to the funds coming from individual investors, unlike venture capital. High return on investment. Angels expect significantly high return on investment compared to banks, which would affect companies' profit. Founder would not be in full control, being part of equity enables to say in company situation. Finally, conclusion. Growth of new finances has opened door for entrepreneurs to realize their ideas. There's no one best type of financing because every financing has its pros and cons. And hope you enjoyed the video. That's all.